That's right. 20 months ago, I told you that Modine was outperforming Tesla and you needed to take a strong look at it. And if you had, you would have seen a 200% run up from $45 to $200 in a matter of less than a year. But that isn't all of the story. And as Paul Harvey used to say, and here's the rest of the story. Well, it was brought to my attention as a result of their earnings call day before yesterday, and I put Samantha on it. Samantha's my AI agent, and I said, "Go give me the latest detail." And what she came back and told me was what I knew because I knew about it 20 months ago. Is they were taking their business, which was the air conditioning business, basically for schools and larger buildings, and they were adapting to this new thing that was happening called data centers, and their business grew dramatically. In fact, in the first quarter of this year, for the fiscal 25, they had a record earnings. They had a 30% increase in revenue and a 45% increase in EBITDA, which resulted in basically from their cooling of the data center, and that business was up 119%, giving them an income of about $644 million. But there is more to this story. As Samantha came back and told me, they had a tremendous run up. They then had a pullback from the 200 that they reached. You can see it here on this graph. It pulled back substantially, and it's now at about 90. But the question is, how would we know to have gotten out at the 200, and how would we know to what we should do today at 90 based on what's going to happen in the future? Now, 90 days ago, I would have just rode the wave and said, hey, they're in the data center business. The data center business is going crazy. They're doing extremely well. This stock is going to go back to a 200 where they had been, except Samantha got into some very good detail. She basically came back to me and said, look, the reality is they're overpriced. They're overvalued. Now, how did she know that? She went and she compared the valuation of Modine to each one of their competitors. And she found out that the PE ratio was out of whack. And as a result of that, and what the CEO and the CFO said on the earnings call, that Modine wasn't going to get back to the 200 that they were about 10 months ago. They aren't going to get back to that like a lot of people think they are. So what she then came back and said is, let's look at it realistically relative to their competition and their TAM and their share of market, and let's come up with some realistic prices. Now, this, again, is buried within a 15-page document that Samantha provided for me. But what I then do is say, Samantha, put this into a podcast, put it into words so I can go out for a 45-minute walk and I can put my iPads in and you explain it to me and explain to me what you believe the price of this stock is going to be in the next 1 year, 2 years, 3 years, based on the data that you have available, and explain it to me. And that's what she did. So I took my walk yesterday, and that's what she did. What I want to do is ask you to listen to what Samantha and Bard told me. I don't want you to read the 15-page document. It's a little deep, but I want you to take your time and listen. It's about 20 minutes, so bear with me, but listen to this.
Welcome to the Deep Dive. We're glad you could join us.
Yeah, great to be here.
Our mission, as always, is to take the source material you provide and really dig into it, pull out those key insights. We're here to help you navigate the data.
Exactly. And today, we're diving into sources provided by Kerry from Best of Us Investors. It's all focused on Modine Manufacturing Company, ticker MOD.
Right. And we've got excerpts from their fiscal 2025 earnings call and also a financial analysis and forecast document to guide us.
Kerry's asked us to look specifically at a few things: how the company's doing financially, its market position, growth potential.
And then get into the stock projections from the analysis and, importantly, a target buy-in price.
Yeah, it looks like a company with a lot going on right now. So let's jump in and see what these sources actually tell us.
Okay, sounds good. Let's start with that big picture, the overall financial health presented in these documents. The headline numbers, they sound pretty strong, right?
They really do. Modine reported record net sales, $2.6 billion, and record net earnings, $185.5 million for fiscal 2025.
And not just a one-off thing.
No, exactly. This is their third consecutive year hitting record results. The earnings call specifically highlighted adjusted EBITDA.
Right. Earnings before interest, taxes, depreciation, amortization. Kind of gives a cleaner operational view.
Precisely. That was up 25% in FY25. And get this, on a sales increase of only 7%.
Wow. So profitability really outpaced revenue growth.
Definitely. And if you look at their past profitability, based on the GAAP financials in the analysis source, it shows, well, quite a turnaround story over the last few years.
Yeah, I saw that. They weren't always posting records.
Far from it. Back in FY 2021, they actually had a net loss of over $210 million. So, navigating some serious challenges.
But since then,
Consistent build back. Growth year after year leading up to these latest record earnings of $185.5 million. It's a very solid trajectory they've been on.
now the analysis source mentions something called the rule of 40%. I've heard this mostly in the context of software companies. Can you explain that and how Modine stacks up according to this source?
Yeah, you're right. It's often used for SaaS or tech growth companies. Yeah. The basic idea is you add the company's revenue growth rate and its profit margin, or sometimes, like here, its EPS growth rate.
And the total should be over 40%.
Ideally, yeah. It's meant to show a good balance between growing quickly and being profitable. So the analysis did this calculation for Modine for FY25.
Using revenue and EPS growth.
Right. 7.88% revenue growth plus 15.06% EPS growth. That adds up to 22.94%.
Okay, so quite a bit below that 40% threshold.
Based strictly on that calculation presented in the source, yes. They don't meet the rule. It kind of highlights maybe it's not the perfect benchmark for every type of company, even one with, high growth parts.
Interesting point. What about margins? The sources talk about both gross and operating margins. How are those trending?
Well, gross margin did see improvement. It went from 21.8% in FY24 up to about 23.6% in FY25. So that's positive.
But operating margin?
That actually dipped slightly from around 10.3% down to roughly 9.6%. The earnings call explanation was mainly higher revenue, but operating income itself stayed relatively stable year over year. Okay. But the expectation they mentioned is that operating margins should improve going forward, especially as that high margin data center cooling business really scales up.
Right. That seems to be the key story. So putting it all together, the profits, the margins, and then looking at the ratios from the analysis, liquidity, solvency, efficiency. What's the verdict on overall financial health?
The sources generally paint a picture of a stable financial position. The current ratio is 1.87. That's pretty healthy. Liquidity suggests they can cover short-term debts.
And the quick ratio?
That's 1.07. It's adequate, meaning they can meet obligations without immediately selling inventory. But it does show perhaps a bit more reliance on inventory compared to companies with much higher quick ratios.
Okay. And debt levels?
Their debt-to-equity ratio is 0.54. That indicates moderate leverage, and the analysis actually notes this is lower than some of their peers, so not overly leveraged.
Good. And on the efficiency side, how are they using their assets and equity?
Return on equity, ROE, looks quite strong at 24.25%. That means they're generating good profit from shareholder investments.
And return on assets?
ROA is 10.66%. Also indicates pretty efficient use of their assets to generate earnings. So overall, the efficiency metrics look pretty decent.
The earnings call also mentioned free cash flow generation.
Yes, they brought in a solid $129 million in free cash flow for the full fiscal year 25. They seem keen to emphasize their strong balance sheet measured a low leverage ratio of 0.7.
And they expect more next year.
Yeah, they expressed expectations for even higher free cash flow in FY 2026. They also touched on a share repurchase program, $100 million announced, and they completed $18 million of that in Q4. So returning some value to shareholders too.
Okay, so the overall financial picture seems robust, clear turnaround, recent records, and the sources make it very clear this performance is heavily driven by their two main segments, climate solutions and performance technologies.
Absolutely, those are the two engines.
Let's dive into those then. Starting with climate solutions, sounds like that's where the action is?
Oh yeah, the earnings call described it as an outstanding year, and the numbers back that up. We're talking a 30% revenue increase for the segment and a 45% jump in adjusted EBITDA.
Wow.
Achieving a 21% margin in FY25. Really strong performance there.
And the big driver within climate solutions is data centers, right?
Unquestionably the primary driver. Data center sales specifically were up an incredible 119% year over year.
119%.
Yeah, reaching $644 million in FY25. The call broke it down too. About half of that huge increase was organic, just more business. The other half came from their acquisition of Scott Springfield.
That's just explosive growth. Sounds like demand, especially in North America, is just through the roof.
Extremely strong was the phrase they used for North America. And they're scrambling to keep up, basically. They're actively increasing production capacity.
How are they doing that?
Adding new manufacturing lines, expanding testing capabilities, specifically for chillers in their facilities in Virginia and Mississippi. They said this is directly tied to orders they already have in hand and what's in their pipeline.
So they're investing to meet that demand. What else is happening in climate solutions besides just building more stuff?
Well, they're innovating and expanding their reach. They launched a new modular data center cooling solution. The call described it as a different product designed for speed of deployment, more plug and play, essentially, versus traditional on-site assembly.
Makes sense for fast-moving data center builds.
Exactly. They're also moving forward with their India expansion to spec production to launch there in Q2. That's aimed at serving Southeast Asia and the Middle East markets.
And acquisitions, too.
Yep. They recently acquired Absolute Air. That's meant to boost their commercial indoor air quality and heating business, kind of rounding out the portfolio.
With this booming data center market, how much visibility do they actually have? Can they see this continuing?
That's a key question. According to the call, they have visibility, believe it or not, upwards of 5 years with some key customers.
5 years? Wow.
Yeah. They expressed high confidence for 1 year out and moderate to high confidence looking 2 years out. So it's not just wishful thinking. There seems to be some contractual basis for this expected growth.
Is this strength universal, or are there regional differences in the data center market?
Good point.
Yeah.
It's not quite uniform. North America is showing that, extremely strong growth we talked about.
Yeah.
Europe, however, was described as adjusting to changing plans from the hyperscalers, the big cloud players.
So some delays, maybe?
Yeah, some delays were noted in Europe.
Yeah.
And the FY25 revenue split reflected that. Roughly 75% from North America, 25% from Europe for data centers.
Okay. So looking ahead to fiscal 26 for the entire climate solutions segment, what's the overall outlook?
Total segment growth is projected between 12% and 20%, but that's heavily weighted by data centers, where they expect over 30% growth again.
Still very strong there. What are the other parts of CS?
Different stories. Heating and school IAQ, that's a smaller piece. They expect low double-digit growth. But heat transfer products, which is a larger business within CS outside data centers, that's projected to be flat to maybe down slightly. 0 to maybe 5% decrease.
Any reason given for the softness there?
They mentioned things like excess coil capacity out in the market and also some customers deciding to bring production in-house. So some headwinds in that specific area.
Okay, so climate solutions is clearly the high-flying segment right now. Let's switch gears to the other main segment, performance technologies. The sources describe conditions there as more challenging.
That's right. Performance technologies deals with markets that are, tougher right now. They mentioned an extended downturn in vehicular markets. Think heavy-duty trucks and also delays and uncertainty around EV programs.
But despite those challenges, the segment did show some improvement, didn't it, in terms of profitability?
It did, which is quite impressive given the market. They managed improved sequential earnings and better margins. Finished FY25 with a 13.5% margin for the year. That's a 200 basis point improvement over FY24.
2 full percentage points.
Exactly. And even more striking, they highlighted an 800 basis point margin improvement that's 8 percentage points over the past 3 years. And this was on relatively flat revenue.
How did they manage that?
Attributed to proactive restructuring, cost-cutting initiatives, and applying their 80-20 approach, focusing efforts on the most profitable parts of the business.
They also reorganized this segment recently.
Yes, they pivoted to just 2 product groups: heavy-duty equipment and on-highway applications. The goal stated was to simplify the structure, make it leaner, reduce costs. They expect this to generate over $15 million in annual savings.
So becoming more efficient in a tough market, what's the FY26 outlook for performance technologies then?
Sales are expected to be down somewhere between 2% and 12%. This outlook assumes the end markets remain pretty depressed, and it also factors in potential negative impacts from trade conflicts or tariffs.
But despite lower sales,
they're actually anticipating higher margins and earnings for the segment, driven by those cost reductions and productivity gains they've been working on. So improving profitability, even if revenue shrinks a bit.
Interesting. Anything else on PT strategy?
Yeah, one more thing. Their plan to exit non-strategic businesses. They specifically called out the traditional automotive business. That's about $200 to $250 million in revenue.
Is that exit factored into the FY26 guidance?
Not entirely. The business is included in the guidance assumptions for the full year right now. Their goal is to actually execute a transaction, sell it off, sometime this fiscal year. But the potential impact of that divestiture isn't fully baked into the outlook yet. Something to watch.
Okay, let's pull back again. Look at the broader picture. Modine's market position, external factors like tariffs. How's their market share looking?
Well, based on the sources, it seems pretty clear they're gaining market share in data center cooling. That's coming from both the acquisitions, like Scott Springfield, and their own organic growth, especially with some of their newer solutions.
And in the other areas, auto, industrial.
There, it seems more like they're maintaining a stable presence. Not necessarily big gains, but holding their ground in those more mature markets.
And the size of the prize, the total addressable market, the TAM, how big are these markets they're in?
The data center cooling market alone is projected to be huge. potentially hitting around $30 billion globally by 2030. That's growing at a healthy clip to maybe 12% to 16% CAGR.
And including to other businesses.
If you look at the broader thermal management market, including auto and industrial, the total opportunity is likely north of $50 billion. So, yeah, very large markets overall.
Tariffs and trade worries came up in their earnings call. How vulnerable is Modine, or how are they positioned?
This seemed to be an area they felt relatively well positioned in, actually. They emphasized their global manufacturing footprint and what they call a local-for-local supply chain strategy.
Meaning they make stuff close to where they sell it.
Basically, yeah. They estimated that less than 10% of their annual purchases are actually subject to the new tariffs, which is, fairly low.
Okay.
They also mentioned having commercial agreements in place to help manage tariffs on finished goods. And their global presence helps customers manage their own sourcing strategies, too.
So not a huge direct cost impact anticipated.
Seems like the bigger uncertainty they highlighted wasn't the direct cost, but the potential indirect impact on overall product demand, particularly in that performance technology segment, which is more exposed to global vehicle markets, sensitive to trade issues.
Makes sense. What about innovation? Are they investing in R&D, new tech?
Definitely. They specifically mentioned innovation in data center cooling things like liquid cooling solutions, AI-driven controls for high-performance computing needs. That seems critical to staying ahead there.
And for vehicles?
They're also continuing to develop thermal management solutions for electric and hybrid vehicles, so aligning with that long-term industry shift.
And all this growth, innovation, capacity expansion requires investment, capital expenditures, CapEx.
Right. The sources confirm they are investing. CapEx is going towards those new manufacturing facilities, especially for data center cooling, and also towards expanding their technology offerings across the board.
Okay, great overview. Let's pivot now to the stock itself, the part Kerry was really asking about. Valuation, price projections that target buy-in price. What did the analysis source say about Modine's current valuation?
This is where things get really interesting. The analysis looked at the PE ratio, price to earnings. At the time, it was around 35.22 based on the data used.
And how does that compare?
Well, it stands out quite a bit when compared to the peer groups selected in the analysis, companies like Aptiv, BorgWarner, Gentex. Their PE ratios were significantly lower. Aptiv around 11, BorgWarner around 12.5, Gentex around 19.
So Modine's is much higher.
Much higher. And it wasn't just PE. The price-to-sales ratio for Modine at 2.17 was also notably higher than those peers, which were more in the 0.7 to 0.8 range.
Did it compare other metrics?
Yeah, it noted Modine's return on equity, ROE, was competitive, but its net margin lagged behind Gentex specifically.
So what was the interpretation in the analysis? Why the high PE?
The source interprets this high PE as the market placing a significant premium on Modine compared to these peers. It attributes this premium squarely to the strong growth expectations, especially in that data center segment.
But it also raises a flag.
Yes, it explicitly raises the question of potential overvaluation when you look at these traditional peer comparison metrics. In fact, the analysis went a step further.
How so?
It calculated a sort of fair value estimate based on the average PE of that peer group, which was around 15. Applying that average PE to Modine's earnings resulted in a fair value estimate of about $53.10.
$53 compared to the price back in May of
around $105.57. So yeah, a massive difference.
That is really striking. So the analysis is essentially saying the market's valuing Modine very differently than its peers, and based on those peer metrics, it looks potentially quite stretched.
That's the conclusion drawn in that particular source, yes.
What about the stock's history? Has it always been this high-flying stock?
The analysis looked at the 5-year stock price growth, calculated an approximate compound annual growth rate, CAGR, I wait for it, 100.6%.
Wow, incredible growth.
Incredible growth over that period, absolutely. But the analysis also stressed that the ride was volatile. A back test apparently showed significant outperformance compared to the market, but with big price swings along the way.
Suggesting timing matters.
Implying that timing your entry could be pretty important, yeah.
Yeah. And where was the stock trading recently relative to its highs and lows?
At the time of the analysis, it was trading near its 52-week high, estimated around $110. The low was estimated around $70.
So strong momentum, but maybe near a peak.
Exactly. Strong bullish momentum indicated, but trading near the top of the range always carries that risk of potential short-term pullbacks.
Okay. The analysis also provided some future profitability projections, assuming, I think, 15% annual EPS growth?
That's right. Based on that 15% annual growth assumption, the projected earnings per share were, for fiscal year 2026, around $4.07. For fiscal year 2027, about $4.68. And for fiscal year 2028, roughly $5.38.
And Kerry specifically wanted those projected stock prices based on these EPS numbers. The analysis used different PE scenarios, right? Conservative, moderate, aggressive.
Yes, exactly, to show a range of possibilities depending on what multiple the market might apply. They used PEs of 15 conservative, 25 moderate, and 35 aggressive, close to the recent PE.
Okay, let's hear those projections for January 2026, 27, and 28.
All right. For January 2026, the conservative projection is $61.05. Moderate is $101.75. Aggressive is $142.45.
Okay, quite a spread there. The moderate is actually below the recent price.
Yeah. Now, for January 2027, conservative $70.20, moderate $117, aggressive $163.80.
And finally, January 2028.
Conservative $80.70, moderate $134.50. And the aggressive scenario hits $188.30.
So even the moderate projection for Jan 2027 is only modestly above the recent high. It really highlights how much depends on maintaining a high PE multiple.
Absolutely. The valuation multiple is key.
Now, the analysis didn't just project prices, it gave a target buy-in price recommendation. What was that?
The suggested target buy-in price in the source was near what it identified as support levels, estimated around $90 to $95.
Okay, so significantly below the $105 price at the time.
Right. The analysis noted that buying in around that $90 to $95 level would align the valuation more closely with the industry PE averages used in its fair value calculation, rather than paying the premium price seen recently.
So the core message from this analysis seems to be, acknowledge the growth, but be wary of the current valuation premium compared to peers, and maybe wait for a better entry point.
That certainly seems to be the implication from that specific source, yes. It also questioned whether that high PE is sustainable.
What did it say about that?
Well, it noted that maintaining such a premium requires not just growth, but sustained high growth, like that 15% annual EPS growth assumed, plus continued margin expansion. It framed it as feasible if Modine executes perfectly, especially on data centers, but also risky given, broader economic uncertainties or any potential slowdown.
Did the source analysis mention the weighted average cost of capital, WACC?
Yes, it did. It estimated Modine's WACC at approximately 9.86%.
Any final notes from the analysis on market conditions or how it ranked the stock?
It made some assumptions, like the stock probably trading above key moving averages, indicating bullish sentiment. It factored in moderate market volatility and, again, potential risks from economic uncertainties, calling out tariffs specifically in this context, likely for their demand impact risk.
And the ranking.
It gave Modine a portfolio suitability ranking of about 65 on a 1 to 100 scale, described as having limited risk but good potential return, suitable for diversified portfolios.
Why that specific description?
The reasoning seemed to be that the growth potential, especially in data centers, is definitely attractive, but the high valuation introduces that moderate risk element. Balancing act.
Okay, so let's try to pull all of this together now for Kerry. What are the absolute key takeaways from this deep dive into the source material on Modine?
All right, the main points seem to be, first, Modine's shown really strong recent financial performance. We're talking record results. And that's largely powered by just explosive growth in their data center business, part of Climate Solutions.
Right. And they're also working hard on the other side, trying to improve profitability and performance technologies, even though the market there is tough.
Exactly. Second, the company appears financially stable based on the key ratios looked at in the analysis. Liquidity, leverage seem okay.
But then there's the big however.
Yeah, the valuation. The analysis we reviewed flags the current stock valuation, especially that PE ratio, as looking significantly higher than selected peers based on traditional metrics.
Which leads directly to that recommended target buy-in price in the source being notably lower than where the stock was trading recently.
Precisely. So it creates this picture of, on the one hand, clear opportunity driven by the booming data center market and Modine's execution on expanding capacity, plus maybe potential from the PT turnaround.
But balanced against, on the other hand, the risks. The risk embedded in that high current valuation premium, plus external factors like the economy or tariffs possibly hitting demand.
It really is a fascinating mix of potential and caution presented in these sources.
It definitely leaves you with something to think about. Here's maybe a final thought for you, building on this. Given that significant premium the market seems to be putting on Modine right now because of data centers compared to its peers, can the company's execution actually building out capacity fast enough, innovating, getting PT turned around, can that truly sustain this kind of valuation?
Or is that peer comparison from the analysis a really crucial signal, a signal for potential caution, maybe highlighting just how important entry timing might be if you're considering this stock right now?
A great question to ponder. Kerry, thanks so much for sharing these sources and prompting this deep dive. We really hope this detailed breakdown is helpful as you weigh the information.
Yeah, thanks, Kerry. And to everyone listening, keep digging, keep questioning, and keep thinking critically about all the different perspectives out there.
Absolutely. Until our next deep dive.
So now then, what do I do with this information? I do this for every stock that I own. Every quarter when they have their earnings call, this is what I do. And as I said, up until 90 days ago, I did not have the ability to create the podcast, to create the document. And then what I do is I take all that information that they give me and I put it on a Google spreadsheet. And then I compare what is the price of the stock today and what is it going to be on January the 2nd of 2028, and what is the differential there to give me guidance as to how much of my money should I have in Modine and how much of it should I have in Madeira. Okay? And that will then tell me, and then also, what is the risk in reward based on those two different stocks. And I show it to you right here on my tell sheet. Okay, that's all of the 40-some stocks that I'm in today. And then as you see these blue categories, that's the financial health. That's the 15-page document. The next one is the briefing. That's about a 5-page dumb down of the 15-page document. And then next to that is the deep dive, what you just heard from Samantha and Bard on every one of those stocks. And then so if you can take 40 walks and listen to Samantha and Bard, take notes as you go if you wish, or just come back to it, pull out the briefing, and it'll break it down into 2 pages, and it'll give you a reading of what Samantha and Bard, and then you can make a good financial decision. Let me show you exactly what I came up with from Modine, and then how I then make my determination of how I want to allocate my funds based on AI. I have access to all the data in the world on Modine and Madeira and Meta. And there it is, and it tells me, based on the data that we have after their last earnings report, Meta is going to give me an 11.26% return on my investment from today to January the 2nd of 2028. Modine is going to give me a 52%. And Madeira is going to give me a 323% return. Okay? Now, next quarter that might change, but it'll be right there. And I can allocate accordingly. That's what I think the power of AI is. That's how I think your investing will be different in the future. If you have access to Samantha or your AI agent, and if you know where to go and which sources of data to pay for, so Samantha can give you an answer based on what happened yesterday or what's happening today, because that's where the hole is. I give Samantha a prompt. It's a 1.5 pages long, 1.5 pages, because it has to be specific. I mean, you can have all the knowledge in the world, but if you don't know the right questions to ask, you're out of luck. So that's what Best of Us Investors is becoming. That's the direction I'm driving it for one specific reason, so that I can make more money, so I can build my wealth to astronomical levels, because I am not depending on the diversification of a ETF or a S&P 500. No, I don't want that. I want to identify the best growth companies in the world and then analyze their financial health to say which is going to furnish first, second, third, all the way down to 40th. And then I allocate my portfolio based on the associated risk. Take a look at it. It's on my website. I call it the Bus Portfolio. It's on my tell sheet. You can access it for 14 days for free. And then if you want it and you want to be a part of it, I'm going to knock you down for less than $1 a day. That's right, $29.95. So, a month. Well, I guess there's only 1 month. That would be, those with, no, yeah, February. February and leap year. It's more than $1 a day. So take a look at it. See if this is how you want to invest in the future. And most importantly, see if it can make a difference in your life. And if it can, come join the tribe.